Good morning, everyone, and thank you very much for joining us this morning. I'm very pleased to introduce you to the webinar organized by the Research Center for Law, Economics and Finance at Brunel University, London. My name is Nigar Hashimzadeh. I'm the director, and I'm joined here by Dr. Stelios Andreadakis, who is the co-director of the Research Center. And the topic of today's webinar is tax challenges in the digital world, taxation of crypto. We have 4 speakers from academia, industry, and the government, representing Australia, India, Singapore, and Germany. So it's quite a coverage of the views on the issue and of the different jurisdictions. So our first speaker is Dr. Elizabeth Morton, who is a research fellow at the RMIT Blockchain Information Hub and the coordinator and lecturer of taxation at RMIT College of Business and Law, School of Accounting, Information System and Supply Chain. Elizabeth's research is directed towards 3 core themes: tax compliance, crypto-related activities, and practitioners' competence. And along with the peer-reviewed and industry, Elizabeth engages with industries through channels such as discussion groups, policy submissions, articles, blogs, seminar, podcasts, and radio. And Elizabeth is also a co-author of the book by Bevacqua and others, Australian Taxation, published by Wiley. And as well as other associations, Elizabeth is a fellow of the Tax Institute, a chartered accountant, a member of the Institute of Public Accountants, and a member of Accounting and Finance Association of Australia and New Zealand. So thank you, Elizabeth, for participating in our webinar, and the floor is yours.
Thank you so much for that introduction.
A little bit of housekeeping. So this webinar will be recorded, and the recording will be posted on the official YouTube channel of Brunel University, London, and you can find it either from there or from the webpage of our Research Center for Law, Economics and Finance. Thank you very much.
Awesome. So I think I've got about 20 minutes to chat. I'll just share my screen again now as I speak. So thank you for having me. It is lovely to be here today. And apologies for the lighting. It's about 7 o'clock here and it's quite dark. So the room is a little bit darker than I was hoping. So hopefully it's okay enough. But thank you for having me. So I'm going to have a chat about my research being undertaken at the moment. So it's an Australian flavour here and looking at the tax practitioner perspectives in this space when we're dealing with crypto activities that the clients, the taxpayers are undertaking. So just to give a little bit of a background, I know this is a very busy slide. It's taken from the Australian Treasury documents, and it just gives you a little bit of a taste of the current regulatory framework in place when it comes to crypto. And the basic premise here is that there's not a lot actually specific to crypto. We look to how it fits within the standard regulatory space. So if we determine that it's a financial product, you're looking to the ASIC regulations. If it's not a financial product, you're looking to the consumer law side through ACCC, and a lot of it is around investor protection. So a lot of the issues that the government is concerned about is how we protect investors from rug pulls, from unfortunate activities, whilst also promoting innovation in this space. From a tax perspective, which is my focus, we have the Australian Taxation Office, which is the administrator of the tax collection system, and we look to the legislation, including the Income Tax Acts and the GST Act as well. So that kind of gives you a little bit of a snapshot for those that may not be familiar with the Australian setting. A little bit of developments, though, are underway. We've had a lot of reviews being undertaken by the former government as well as continuing on with the current government. This includes, for example, the Treasury's token mapping exercise in February 2023. The consultation began on that, but it's really, whilst it's looking to map out tokens generally, there's a substantial focus on the financial services framework. So as to whether that really spreads deeply to the taxation implications, it's probably a little bit not quite there yet. But we do have the Board of Taxation's review of the tax treatment of digital assets and transactions. That's a really key development in the space at the moment. It was spurred on by the former government's review, their final report that was led by Senator Andrew Bragg, who essentially recommended that the CGT provisions be amended, whereas the government response there was to actually take a broader contemplation of it and actually understand the broad treatment. And that's fundamentally due to the fact that when we look to crypto activities, they're not going to just have implications for the CGT or capital perspective. They can flow on and intermix with income and other areas. So it's not going to be such a narrow scope, and I think that's really important. But with that kind of development and more broader investigation, that takes more time. There's a lot more uncertainty whilst we get to that point. So that was instigated by the former government, and that was continued on, but with a delay. So the original report was due in December 2022. However, that is now looking to come out in September 2023. And really that's a reflection of the massive task that is to really examine how the tax system operates across the board and all the intermingling issues for a very complex area of the economy. We also have a little bit of actual development within the legislation space here, and that's through the Treasury Laws Amendments Bill 2022. It's quite a small, I guess, low-hanging fruit type of amendment here. Schedule 2 essentially aims to ensure that digital assets like Bitcoin won't be captured within the foreign currency regime. So it's really narrowing the scope to most likely the capital provisions, the CGT provisions there. And that really comes about through the developments in El Salvador and other similar jurisdictions that have allowed Bitcoin to be or recognized Bitcoin as legal tender. And that essentially created some uncertainty about whether that led to a shift in the treatment in Australia. So really what this bill, Schedule 2, is doing is bringing back a status quo from the 2014 tax determinations that I'll kind of touch on in a moment. So it's not a substantial change. It's really ensuring a position was the position that the government was aiming for. And as we've seen the crypto winter last year, a lot of the drama and developments in a problematic perspective come through. There's a lot of consequences of that, keeping out of foreign currency provisions and keeping in the capital provisions, where in Australia there's quarantining essentially happening for losses and such. So there's certainly the impact that will be seen, but it also creates certainty in how that operates. So when we look to the particular guidance we have in Australia for crypto, we have primarily a set of tax determinations that were established back in 2014. And so that's quite a long time ago now. And they're primarily directed to Bitcoin and similar assets. We know now that there's a whole lot more going on in this space, but they've been essentially the fundamental starting point in understanding and interpreting. But we need to be mindful, though, that these tax determinations are produced by the Australian Taxation Office. They represent the interpretation of the law, and so they in themselves are up for questioning within the courts if a taxpayer was wanting to push and disagree. And we're certainly seeing a lot of that development in the background, but not yet coming through in a strong sense, apart from that first listed one about Bitcoin falling within the foreign currency regime or not, with the government's response to change the law to really ensure that that 2014 position stands. So we have these set of determinations. They really give us a little bit of posts that we're closing in largely the capital gains provisions, unless they're business taxpayers, but majority of really a lot of the guidance is centered around the investors, the speculators in this space. So it's going to fall within the capital gains provisions. It's not going to fall in foreign currency provisions. And so there's a little bit of detailing around that. We have seen the government shift a little bit on fringe benefits, but it's really to recognise the nuances there. So if you have a valid salary sacrifice arrangement in place, it will be a property fringe benefit and dealt with by the fringe benefits legislation. But if not, it would actually fall within the income, be assessable income at the Australian dollar values. So we are seeing a little bit of movement here and there, but these positions have been fairly steadfast. But what we do have is a whole lot of web guidance that supports the growing nature of and the experimentation going on in this space. So as I've noted on the slide, we've got about 1 million taxpayers expected to lodge a tax return in 2022 that includes crypto activities. We're now in early 2023. We don't really have the data to know how that's fallen out, but that's certainly not unexpected because other surveys have indicated about 25% of Australians have held or hold crypto assets. So we are expecting quite a substantial amount. And so we often go to that web guidance for clarity. We're trying to apply traditional tax principles that have been developed over the court system over decades and decades. They're very, very well established, but not really designed or contemplated for the crypto economy that has such a contrasting and whilst analogous activities, kind of not the same. So there's a lot of difficulty in doing that. So with that web guidance, we do have to be mindful that the level of reliance or safety net that web guidance provides, as opposed to the formal tax rulings that we have from 2014, does vary a little bit. And this is a little bit of a point of contention. In particular, we have taxpayers that can go to a tax ruling and feel fairly confident if they're a relevant taxpayer, so their circumstances align, despite it being the administrator's interpretation of the law, they have that protection. So ultimately, if the courts work out that it's not quite right, they still have a lot of protection of that. But the web guidance side of things, we can update it time and time again more easily than a tax determination. But at the same time, it doesn't have the same weight of protection as a tax ruling does. So web guidance offers a really good way to help guide taxpayers and tax practitioners that are delving into the crypto space understand how they ought to from the perspective of the ATO, but it's difficult in a sense because there's not the same level of safety or protection. And so there's a little bit of a double-edged sword there. And secondly, we've got to be mindful that web guidance can be updated readily. Therefore, that position can shift a little bit. So it's generally broad guidance. And so how you interpret the detail and the logistics and the reality of that, if it doesn't quite align to further guidance, then you might go in and have to go through the amendment process. And we saw that a little bit last year with shifting guidance on airdrops. So airdrops had broad guidance up until about September, and then it shifted in its explanations and provided a little bit more clarity and distinguishing much more precisely the style of airdrop that was being considered by the ATO. So what would fall in, what would fall out, if you had already held the property, or if it was an airdrop of the first time ever of that particular crypto. So it distinguished the kinds of airdrops a little bit, but we probably know if you've played around in this space and you know about airdrops can really be diverse, and it's a hugely complex area in itself, but it's a step towards a little bit more depth and nuance there. But fundamentally, if you'd already submitted your tax return in July and August, it meant that you may have had to then go and unwind and shift a little bit. It possibly could have been a positive shift because you might have recognized it as income, when ultimately the advice now suggests that you may not have. So it may not be a detriment, but there's that administrative compliance burden that we've got to be mindful of. And that's some of the challenges that we're facing. So with this, we've got to be mindful as well of the data capturing that the Australian Tax Office actually has in this space. So they have a law enforcement tool, administrative tool, the ability to capture information and collect it. And they certainly are developing a program to do that in this space for crypto since around the 2015 year. The program itself has been around since 2019. So they were sending letters out, going back a little bit, and led to hundreds of thousands of additional reports of crypto assets being included in tax returns in 2021. So it was having an impact. We do have to be mindful, though, that it is quite a narrow program. So it generally focuses on the digital service providers and that those that are registered with AUSTRAC, which is an Australian organisation, again, one of the regulators. So if you're undertaking activities that don't get captured by or don't interact with these digital service providers, you're not going to be captured by this program. Therefore, you're not going to get flagged in the pre-fill report that can come through and make a lot of tax returns a lot simpler to do. It may simply give you a warning that you've got this activity going on if you've been interacting with these exchanges. But otherwise, if you're undertaking the more nuanced DeFi, the decentralized finance, you're undertaking activities where you've never provided any ID, never done anything like that. You might have been airdropped money, airdropped crypto, I should say. So you may never even have a connection to a bank account. It may simply be the app on your computer or the app on your phone that's the pointer to you. So the ATO may not be there yet, and it will take time to work out how they can better broaden out that information. But that's a really sticking point. My research is indicating a lot of the conversation starters a tax practitioner has with their client is the discovery on the pre-fill report, that warning, and they wouldn't have raised that beforehand. And so if that's only essentially capturing a piece of the pie, then there's a lot of clients out there that may actually not truly be engaging with their tax practitioner, engaging in the compliance function that they're required to do in this space. So I know that's taken about the majority of my time to discuss, but I'm going to just touch on a couple of elements of the research. So I've got a massive slide deck here, and I'm just going to flick through to a couple of the points that I want to make. And this links to some research I've been undertaking that's been funded by AFANS with a team from RMIT in Swinburne. So we've been looking and we've been interviewing and surveying tax practitioners. So examining essentially the implications, and most importantly, this goes to the compliance requirements for taxpayers, so the clients, but also as the tax practitioner, their obligation to engage in their client and abide by codes of conduct. So we have 8, we have in Australia, we've got the TASA 2009 as well. If you're a registered tax agent, that you have to abide by the code of conduct, and it requires you to act competently, take reasonable care to ascertain the client's affairs. But there's this knowledge gap that's potentially arising, not only of the blockchain activities themselves, but how the law applies to that in this kind of huge level of uncertainty going on. So we've been exploring that. So I'm just going to jump through to a couple of bits. So we surveyed, we got close to 300 responses, but we paired that back to 229 based on the standard processes of cleaning up the data. But just some of the key kind of takeaways in the last few minutes of this presentation. Firstly, the amount of time that is actually being spent on blockchain related activities by tax practitioners, I mean, it depends on the kind of practice. If you're really kind of out there ready, really out there driving for the crypto economy, you're going to be up there to quite a substantial proportion. There are tax firms out there, but a lot of the tax firms out there they've got a small pocket, but it's not an insignificant amount. 1 to 5% of their time is being spent on this space. But interestingly enough, the taxable income that's estimated out of this, that the clients are actually spending, is not nothing. Whilst you've got a majority of 1 to 5%, if we compare that to, for example, the superannuation system in Australia, the super guarantee charge is about 12%. I mean, it's equivalent to putting away for your retirement. So that's not an insignificant amount. We often see it as a gambling activity, but we need to be mindful that it's not nothing that we're playing with here, and so there's that risk of losses, but the compliance burden as well. Just a little bit of a snapshot on the kinds of activities that tax practitioners are flagging. This is probably really difficult to read on the screen there, but a lot of it's your kind of most obvious things like the standard trading, the moving between wallets and exchanges. We've got a lot of staking activities, but we do have a lot of contrasting between investment or trading. But you can see airdrops are up there, NFTs are up there, but things like DAOs are growing. There's a lot of, like, you know, we can see a lot of the shifting. And I think if we did this snapshot in another year's time, we'd see a lot of the more complex areas coming up more strongly. And I'd go to my caveat that I said before about if it's the tax practitioner flagging with the client through the pre-filled data, that ATO matching, the ATO matching is only picking up most likely that investment trading activities. They're not necessarily picking up or able to pick up on a lot of the more complex areas. So that requires that engagement with the client specifically. So some interesting issues playing a part there. The tax issues mimic those kind of issues, those kind of activities we see, whether it falls as ordinary income or capital. The record keeping is really high up there, but valuation is incredibly important and an issue for clients and tax practitioners. But again, where does this lead us? And I'm going to probably finish on this point because I know I'm about the 20-minute mark, but highlighting the fundamental starting point we're at here is that tax practitioners don't really see the pre-filling data, the guidance, or the existing tax law as fit for purpose for this space. And I think that's a fundamental issue. Now, we can parse out the complexity there as being about the challenges in the unknown and the fact that it takes tax practitioners time to engage with the ATO, get that feedback and understand whether they're on point or not. And we're really seeing the first couple of years cycle of this. And so again, if we took this snapshot in another year or two, will we see an improvement there as everyone starts to understand where we're at, how we're playing at this, and what we need to do? But fundamentally, there's issues with the cumbersome nature of this space, the lack of specificity we have, and the slow-moving regulators. But fundamentally, there's a recognition that it's slow for a reason, because if we have rushed, if we have uninformed legislation, you know, that could be much worse than what we're dealing with now. And fundamentally, we need to get it right. And this is a really good opportunity as we see the Board of Tax move through with their process to see exactly what's noise, what's reality, what we actually need to achieve, and what will be well balanced. Because for a good tax system, we need something that is both technology neutral, simple, yet equitable, and all those other factors that make a good, robust tax system. So on that note, I'll stop sharing and I'll hand it back to you.
I think we should move on to our second speaker. So thank you, Elizabeth, for your very interesting talk. And our next speaker is Manohar Samal. Dr. Samal is a senior associate at Ratan, Samal and Associates in Mumbai. And he's also empaneled as an arbitrator with the Indian Institute of Arbitration and Mediation and the Center for Online Resolution of Disputes. He specialized in the direct tax as well as indirect tax litigation, commercial litigation, and arbitration of construction, banking, and technology transfer disputes. under Indian law. So Manohar, please, the floor is yours.
Yes, thank you. Thank you for the introduction. Can I confirm if everybody can see the screen? Okay. All right. So I will be focusing mainly on the GST, the goods and services tax, the indirect tax aspect of crypto assets. The main reason for this is we had some sort of clarification coming in from the Finance Act 2022 in respect of how income tax is supposed to be paid for crypto assets. But there continues to be no clarity as such in respect of how GST is going to be levied on these forms of transactions. So despite the fact that tax has been one of the most ancient instruments for governments to make money, there has been a sort of laxity in them, and they've not been able to keep up with the technological advancements. And this has been a consistent pattern all over the world. And the GST is the Indian GST is no exception to this. And it's been very difficult for the crypto industry to be able to assess and to firstly classify how their crypto assets are supposed to be classified or even valued. And in fact, there is a significant difficulty from the administrative machinery perspective as well. So we certainly do have GST being levied at the present moment, but it's happening at the residuary rate. Now, a residuary rate under the Indian jurisdiction is where, let's say, if a particular goods or service does not fall into any slab which is being provided by the government, then that is the residuary rate where that particular goods or service is supposed to be put inside. Now, coming to if there is a particular definition or not, during the Finance Act 2022, they sort of made an effort to define how a crypto asset, what a crypto asset would be in the first place. And they came up with this term called virtual digital asset. So in terms of India, any crypto asset would be a virtual digital asset, and there's a huge definition given. And this definition would include not only cryptocurrencies, but would also include non-fungible tokens, security tokens, and utility tokens as well. Although this has been done under the direct tax regime, through the referential legislation principle, we can apply the same definition under GST as well. So before moving forward, it is necessary to understand a very basic idea of how GST works in India, because since this is a sort of cooperative federalism happening between independent states and the central government, we have a slightly different structure. Although, GST is inherently itself a value-added tax. So we have 5 legislations and a bunch of these 5 legislations are leading to the implementation, the levy and the collection of GST in India. The central goods and services tax and the state goods and services tax are levied on equal rates, and the integrated goods and services tax operates on import-export transactions and transactions which happen from one state to another state. And the cornerstone of the Indian legislation is supply. Now, as far as the classification of goods is concerned, the Indian GST is aligned to the HSN, the Harmonized System of Nomenclature, since we have also ratified the convention. And the services portion is aligned to the United Nations Central Product Classification. And they call it the Services Accounting Code in India. There are various slabs of tax rates under the Indian GST, which can range right from 0.25% to 28%. And the residuary rate, which I've been talking about so far, which the crypto industry has been using, is 18%. Now, as of 2023, it's estimated that there are 156 million users, and it continues to grow on a daily basis. looking at this, it is in fact very vital that there should have been some sort of clarification from the government coming in. But we are yet waiting, since consultations are going on from each and every state. And each and every state is first trying to understand how the crypto industry functions. So there's been difficulty on the portion of on the part of the government to understand how the industry functions, and because of this, there are no express clarifications taking place. And we as practitioners have been classifying each of the, crypto assets in the most remotest form, the most remotely applicable rate which is applicable, and the most remotely applicable classification, which is causing divergence in view between practitioners and the GST department, resulting in significant litigation. Now, firstly, the issue consistently on all crypto assets is, are we supposed to treat it as goods, or are we supposed to treat it as a service? The Indian government has taken up some efforts in order to classify how an electronic transmission is supposed to be, classified. And they came up with the concept of OIDAR. Now, this concept, the full form is Online Information Database Access and Retrieval Service. Now, this, in case there is any sort of transmission over the internet, that would be considered as OIDAR, and a flat rate of 18% would be classified. So far, it has been the GST department's view that the entire crypto asset industry functions on OIDRs, has to be treated as an OIDR service. Now, the difficulty which arises is in terms of non-fungible tokens, because we have the token itself, and we also have an underlying asset, which could be in the form of a painting or a music or any sort of creative art. So the question which arises while determining something or giving it a tax treatment is, would the underlying asset of a non-fungible token be the one which has to be considered for the purposes of levying tax or ascertaining the rate, or is it the token itself? And this so far has not had any form of clarification. Now, there are several NFT marketplaces and crypto exchanges in India. Out of that, in March 2022, 11 of them had to face investigation proceedings from the GST department. And they recovered as much as 11.64 million US dollars equivalent from them. The difficulty which arises at this transaction is, let's say, A is offering a particular cryptocurrency, and B is the person purchasing that cryptocurrency. And we have a marketplace or a crypto exchange in between, which is facilitating the entire transaction. The Goods and Services Tax Department has been of the view that GST has to be levied on the entire portion of the transaction and not only on the commission. The main difficulty which arises in this situation is that when a particular business entity decides to run an NFT marketplace or a crypto exchange, they are merely collecting commission, and that commission becomes the only income. So when you say that you have to pay tax on the entire transaction, and even on the portions which I have not received or I am not related to, and the purchaser and the seller themselves are settling those transactions, it makes it very difficult to conduct business because the tax rate goes at a very huge and causes a hole in my pocket. So far, these NFT marketplaces and the crypto exchanges have been paying tax on the entire transaction instead of only the commission. Now, despite the fact that we do have a mechanism for these types of transactions, that has not been applied to the crypto industry yet. And generally, in, let's say, an electronic commerce transaction where somebody purchases something, let's say from Amazon or something, Amazon, under these circumstances, would only have to pay 1% of the tax credited at source on the entire value of the transaction. Whereas the crypto industry is being made to pay 18% on the entire value of the transaction. This has created significant difficulties for them to operate. But in order to escape harassment and in order to avoid the difficulties during the investigation proceedings, what they've done is that they've merely complied, and they're still waiting on clarifications from the government's end. So specifically coming now to security tokens. Security tokens are inherently nothing but a tokenized form of, let's say, a share or any form of debt instrument, which allows a company to raise money. Although in India, we have a very inclusive definition of securities under the Securities Contracts Act. And this has a lot of capacity to include security tokens as well. But we've had no sort of clarification coming in from the securities market regulator. And this has resulted in the question as to if security token would be a taxable product or if it would not be a taxable product. Because under the Indian GST, something which classifies as money or something which classifies as a security is not taxable under GST, and it is exempted from indirect taxes. But despite this situation, due to the lack of clarity, tax is being collected from security tokens. From the proceeds of security tokens as well, treating it as something which has to, incur 18% rate of tax, which makes it very difficult again for companies to even think of going for such mechanisms. And they just stick to the old ways of raising money here. And furthermore, there is yet, a lot of lack of clarity when it comes to the gas fees, which has to be paid on a blockchain for executing either an NFT transaction or a cryptocurrency transaction. And here, the rate of tax applicable to Bitcoin, the cryptocurrency miners or the people assigning hash values is also yet to be determined. Although we certainly do tell them to pay tax under the most remotest form, which is providing support services to, information technology service providers. And we've had valuation challenges here as well, because here although we do have a very comprehensive mechanism for valuating or assigning value. The difficulty here is cryptocurrency is not treated as money in India, because recently we've introduced our own central bank digital currency. And only that central bank digital currency has been treated as money. So naturally, there's no tax on it. But a cryptocurrency is seen as a commodity. So let's say if you avail service or if you purchase something and you pay cryptocurrency for it, it will be treated as a barter transaction, a barter of commodities, and not as something which has been paid in consideration. So although there is a rule provided, the rule inflates the value, even though the actual money or the actual considerations value must have been very lower. So the valuation mechanism under GST says when there is a barter transaction, the open market value of the supply has to be considered, which means if a particular NFT is traded on a particular NFT exchange, the value assigned to the NFT by the exchange would become the open market value, and that value will be assigned, and tax will be levied on that value, irrespective of the fact as to what was the actual consideration paid between the parties. The tax administration challenges side, since GST is a self-assessed tax, up till the period of time the companies themselves do not come forward, file returns, and declare their particular liabilities, it's very difficult for the authorities themselves to understand what transactions have taken place. They certainly do have interagency support from the income tax department and from other agencies. But by that time, 5 to 6 years have gone away. And after 5 to 6 years, when a dispute comes up, you are saddled with a significant amount of interest and penalties, where they say that, fine, 6 years ago, that transaction which happened, you've not paid tax properly on that. Now pay the entire tax amount along with the interest and penalties, which creates the significant difficulties. In fact, I think the GST department has still not gotten their head around how the cryptocurrency industry works yet. And we are expecting a lot of disputes to come in the next 3 to 4 years once they start catching hold of the concepts or the mechanisms in which a crypto transaction is executed. So far, this is pretty much my presentation, and it calls for the need of more deliberation from the part of the government and more participation in order for us to receive clarifications. So I think that's it. Any questions? Please feel free to.
Thank you very much, Manohar. Very interesting presentation. I can see that there is a lot more questions than answers and a lot more problems than any solutions proposed. And we're now ready to move to our next speaker, Dr. Vincent Uy. Dr. Uy is a lecturer of law at the Yong Pung Ho School of Law at Singapore Management University and specialist counsel at Legal Inc. LLC. He has published several peer-reviewed articles on crypto taxation in leading journals and have written for the mainstream media. Vincent has recently engaged as a consultant by the United Nations to analyze risks which crypto assets pose to tax systems. And in 2021, he was awarded a grant by the Tax Academy of Singapore for crypto taxation research. Vincent's crypto research has been cited by leading organizations such as the United Nations and European Commission's Joint Research Center. So thank you, Vincent, for agreeing to present at our webinar, and the floor is yours.
So thank you very much, Professor Nigar, for the invitation. I think you mentioned that this area actually throws up more questions than answers. I'm afraid after listening to my presentation, I'm only going to add to that problem. There are going to be even more questions over here. All right, so let me switch over to my slides, please. Okay, so first of all, I understood when I was asked to present that we would be speaking to a very intelligent audience, but one where I couldn't assume that they understood any crypto or tax. And so I'm afraid we might have to spend a little bit of time going through the fundamentals, which might not be required in this case, actually, because I'm seeing a lot of familiar faces with a lot of expertise in crypto. So please do bear with me if things are a little bit slower at the start. Okay, so let's get started. What are crypto assets? I think a lot of us here might be relatively familiar with this. It's not really a consensus that we have at the moment, right? There's still a lot of definitions floating around. For tax purposes, I think we can understand them to be digital representations of value supported by distributed ledger technology. But I guess the important thing to note is that the exact nature of crypto assets may not necessarily be as important as what their functions are and what their characteristics are, what the surrounding circumstances of the transactions in which they involve are. Arguably, crypto assets are merely a subset of digital assets. And so we've actually got a pretty interesting field of taxation, digital economy taxation that's going along quite nicely. We can just view crypto taxation as an extension of this. And as I will go on to show, and indeed, as several of the presenters have mentioned earlier on, we are really just trying to apply orthodox tax rules at the present moment to crypto assets and transactions. Whether or not these rules are applied well, whether or not we need to change the application is a different question. But the starting point is, in the absence of any kind of specific legislation dealing with crypto assets, we just apply entirely orthodox tax rules as they currently exist. However, there are a few points about crypto assets which I think we might like to take note of. So for tax purposes, we note that crypto assets tend to be intangible assets, right? So in situations where a distinction might be drawn between a tangible and an intangible asset, certainly crypto assets would be on the intangible asset side. A second factor, crypto assets are manifestly not money. So no matter how much they look like money, no matter how much of the functions of money which they seem to satisfy in some situations, I think thus far we haven't found any jurisdiction that's willing, as far as the common law is concerned, to say that they are money. While things are complicated a little bit, I think Elizabeth mentioned this, there are now other jurisdictions that do recognize, some forms of cryptocurrency, specifically Bitcoin, as legal tender. And as indeed she has mentioned, that has created a bit of an issue as far as, tax systems are concerned, right? Because if Bitcoin is considered to be legal tender in another jurisdiction, then do we accord it the same status as a foreign currency, for instance? I think the short answer to that is no, for the moment at least. We haven't really found any jurisdiction that's willing to do that. And the other point to note is that crypto assets are really a blanket term for a whole bunch of different kinds of digital assets and instruments, right? So it shouldn't be surprising that in some situations, they would overlap with existing intangible asset categories. So for example, I could have a digital token, right, a crypto asset that is a share, right? But it could also be considered to be a share for the purposes of tax law as well. So it could be not only a digital token, but also a share. There is nothing precluding a particular digital token from falling into both of these categories. And of course, if it is a share or any other kind of intangible asset, we will apply the tax treatment of any existing intangible asset category to it. So moving forward, as I mentioned, as far as crypto assets and transactions are concerned, the starting point is if we do not have any specific law talking specifically about crypto assets, we will just have to use the existing toolkit that we have. And what we're seeing is that, generally speaking, it is the courts that have been forced to interpret existing legislation because, to be frank, parliaments are not quite moving fast enough to keep up to date in terms of legislating, how the tax rules should apply to crypto assets and transactions. But indeed, as Elizabeth was saying, this is something which we don't want to rush into, right? You don't want to, having not understood fully how crypto assets and transactions work, create a whole bunch of legislation that is supposed to apply to them. So it's understandably going to be a bit of a lag, right? Commerce will rush ahead, as it usually does. The judicial made law will come in and try to deal with the law as it currently stands. And eventually, when things have settled down a bit, I think we can expect a bit more legislation. But until that happens, of course, well, we tax lawyers have the challenging task, if I can say, of trying to apply your existing orthodox tax rules to crypto assets and transactions. So the other point I'd like to make, that generally speaking, the fact that an asset is a digital token doesn't generally change the tax treatment in and of itself. So whether it's a crypto asset or whether it's an orthodox traditional asset or so, we still take a look at the characteristics of the asset. We still take a look at the surrounding circumstances. Of course, new legislation specific to digital tokens is gradually being introduced. I'm very happy at this point to say that I think my previous presenters have actually provided plenty of examples in this area, so I'm just going to move on. Clearly, there are certain jurisdictions that are already coming out with specific legislation for crypto taxation. And of course, if there is specific legislation, it will override whatever general principles that apply. I should add that I have myself argued in other situations that we might want to come out in certain situations with legislation that is specific to digital tokens, because, as Elizabeth has mentioned, the current legal framework may not necessarily be fit for purpose. And I think we'll come to that when we're talking about the deduction of crypto losses in general later. So, key principles. I think this is rather uncontroversial. Tax liability is basically a derivative of economic activity. If you don't have economic activity, it's typically quite difficult to find something to tax in the first place, right? And so whenever there is some kind of economic activity, especially in this context of crypto, the question we need to ask ourselves is whether it may trigger some sort of tax event. And the kind of categories of economic activities that I like to view the crypto world in are those of creation, transfer, and disposal, what I call the life stages of a crypto asset, right? So as a crypto asset goes through these stages, we can use this framework to try and analyze what potential tax implications may arise, from crypto assets and activities. So again, I should reiterate, we do need to take a look at the precise circumstances of each case, right? Whenever we're talking about what the tax liability should be. However, there are patterns which we can spot. And what do I mean by this? I'm saying that if you take a look at the type of token in question, if you take a look at the type of activity, you will tend to see that there's a tendency for certain kinds of patterns to emerge, certain kinds of tax liability to be imposed in these kinds of situations. So it provides a pretty good rule of thumb, a way for us to navigate this rather complex and messy field, right? By looking at the type of token and also the kind of activity in question. So the three kinds of tokens that have existed kind of from the start: payment, utility, and security tokens. The first point I'd like to note is that the classification, of course, came initially from securities regulation and not from tax law. So I think we can very legitimately ask whether or not this classification is fit for purpose. But to go through things very quickly, of course, payment tokens intended to be mediums of exchange, right? They are not recognized to be fiat currency. Now, of course, there's only two jurisdictions at the present moment that do recognize them as legal tender, El Salvador and the Central African Republic. But in general, the idea behind a payment token is that you use it, because somebody else will recognize it as a medium of exchange, and you use it so that you can purchase goods and services. Utility tokens, another major category. The idea behind a utility token is that a person will issue a utility token on the understanding that it can be redeemed at a later stage for goods or services. And of course, this is analogous to vouchers. Indeed, we will see that in most cases, the tax treatment is simply going to be that of orthodox vouchers, right? Security tokens tend to be the most complex. We can understand them as, being a way in which you could raise capital, but of course, it's not so limited, right? Typical examples of your security tokens would include those analogous to equity or debt, so it could be a share, it could be a debenture, or so on and so forth. But the thing to note about security tokens is it's actually a lot broader than that. So there's a whole category of what are now called asset-backed tokens, where essentially you have a token that is backed whether it's in the form of fiat currency or some other form of asset. So if I can move on, I'd like to make 2 points about this current trichotomous division of tokens. First of all, they're non-exhaustive, and then they're non-exclusive. So what do I mean by this? Non-exhaustive, I think, is pretty straightforward. There are 3 categories that we see over here on the screen. As we will go on to see pretty shortly, I don't think that these 3 categories are going to cover all possible cases. It is definitely the case that we've seen other kinds of tokens that don't fit very nicely into these 3 categories. And indeed, as I mentioned, because these 3 categories came up very early in the development of crypto, while the technology was still kind of in its infancy, and it came from securities regulation, one might very well expect, that things have moved on since then. And then the second point, these categories being non-exclusive. So what I mean by that, simply put, a token can fall into any one of these categories and more. It could simultaneously, for example, be both a payment token and a security token. And in that situation, we might call it a hybrid token, right? So just because a token falls within the category of being a payment token doesn't necessarily mean it cannot also be a security token on top of that. So I think in the early days of crypto, especially when it came to securities regulation, we had a lot of very dodgy arguments coming up saying, oh, I don't have to be regulated because it's not a security. Why? Because it's a payment token. Well, that kind of logic certainly doesn't fly because, as I mentioned, just because something is a payment token, it doesn't necessarily preclude it from being something else as well, right? So I'm going to raise a couple of examples, to show how things have developed kind of since then. NFTs, for example, your non-fungible tokens, they don't comfortably fit into any of these 3 categories, right? The idea behind a non-fungible token, of course, as the name suggests, is that each token is actually unique. Right? So unlike your other kinds of general tokens where there is no real difference between one token and the next token, a non-fungible token, there is a difference, right? Each token is unique. So they don't quite fit into the payment token category because quite often they're not really intended to be used as a means of exchange, not really a utility token either. You may not be able to exchange them for anything. And while in some cases your NFT may give you a right to an underlying work of art, for example, in a lot of cases, they don't. So you can't quite consider them to be security tokens. It doesn't fit in quite so neatly as well, right? And I think as the technology progresses, we will see a lot of tokens that don't quite fit into these categories. And as I think I will go on to say in the presentation, this basically creates quite a headache for, well, shall I say tax lawyers, but basically everyone in general. Because in order to figure out what the tax implications are, you'll actually have to do analysis from scratch. If it's a new kind of situation, you can't rely on the rule of thumb that I'm talking about and going, oh, I think that it looks like a transaction like this. You actually need to go and analyze things from scratch and figure things out, particularly as the tokens become more developed and less recognizable. So then there's the issue of a stable coin as well. So what is a stable coin? A stable coin basically is a token which the value is pegged in some way to some other external value. So the most common kind of stable coin, or should I say the textbook case of a stable coin, is one where you have an asset-backed token. So if I tell you that I have a token that is pegged to the US dollar, I might achieve that by keeping value stable by having a single US dollar available, to back each and every one of my stable coins. Of course, I don't think that actually occurs in practice. Even our money nowadays is not really backed anymore by gold, right? But the idea behind the stable coin is that the value is supposed to be stable. Now, it is of course very expensive to back it using, real assets like, precious metals or currency. And so what a lot of stablecoins are doing nowadays is they're known as algorithmic stablecoins, where you use a code and set of economic principles to try and ensure that the value is pegged. I have never truly been convinced by this idea, and I think we can see with recent events, especially the recent crypto winter, things may not be quite as stable as we think they are, right? If you are putting your faith in the algorithm behind it, well, I wouldn't be surprised if things don't work out all of the time. Then we have the issue of central bank digital currencies. So in my research for the UN, we did a little bit of a survey, and it appears as if practically every central bank in the world is trying to hop onto the bandwagon and come up with their own central bank digital currency. Now, I can understand where they're coming from a tax administration standpoint. Now, obviously, if the main crypto asset that is being used in your country is one that is controlled by the central bank, you might not have so much of a problem when it comes to compliance and ensuring that you have a record of all the transactions that's going on. The difficulty, of course, is that different countries are, shall I say, prepared to a different extent to roll out their own CBDCs. And so we are coming to a situation where there is a risk, that countries that may not really have the expertise or the resources to roll out a CBDC will want to do so by themselves. And I think, as we've noticed, particularly in the case of Nigeria, if I may say so, that even if a CBDC is rolled out, it doesn't necessarily mean that people will want to use it, right? I think we're seeing in Nigeria that even though there is an official e-Naira that has been rolled out, ultimately people still seem to be going to the private sector stablecoins, if I can put it, private sector cryptocurrencies, if I can put it that way, right? So there is a question as to whether it is efficient for all of these countries to be coming up with their own CBDCs. Let's move on very quickly to the life stages of a digital token. So a lot of this is fairly technical stuff, but basically all tokens will have to be created at some point. The common way of doing so is through mining or forging, right? This is a process that tends to be, I would say, unique to digital tokens, in the sense that because the system is a decentralized system, you need it to be maintained. And the idea behind mining and forging is that tokens will be given to those nodes, to those computers who are offering up their computing power or participating in some way to enable the system of exchange of crypto assets to work, right? And of course, the question is, if you are providing a mining and forging service and you receive certain tokens for that, what is the tax status of that? Do you have any tax liability from doing so? Many jurisdictions have taken the position that if you're doing it commercially as a business, then it would be taxable, but not so much as a hobby. Then there is your other huge category of issue and purchase, right? As you would issue and purchase any other normal kind of orthodox good like a voucher or security, it really depends on the surrounding circumstances. So if you are, for example, issuing utility tokens, it's very likely that the tax treatment is going to be analogous to be that of the issuance of vouchers. If you're issuing securities, well, are you issuing a debt security or an equity security, right? So it's impossible to say that just because what you're doing is issuing a digital token, right, that will tell us very much about what the tax implication should be. We really need to take a look at what the digital token does. And the thing about digital tokens is they are extremely flexible. There's a whole range of things that you can program them to do. To a certain extent, we do question, is it useful to use the term crypto asset and speak about it as if it is a separate term of asset to begin with? Or should we really just be looking carefully at what each particular token does? Okay. My view is that there is still some utility to taking a look at crypto asset as a separate field, because it gives us a means to navigate what is a rather complicated field. And, it just gives us some guidance, right? Rather than looking at everything in isolation. So transfer, of course, I would say this is probably the largest area for digital tokens at the moment. You can see them being exchanged for goods and services, other tokens, fiat currency, so on and so forth. We've even heard of quite a few situations where digital tokens are paid as salaries to employees. I have actually dealt with a few cases with clients where, unfortunately, they were paid their salaries in digital tokens. They kept it in the exchange, which happened to be some of the exchanges that essentially went insolvent. So that creates a very, very nasty situation, because you would still be taxed on the income you received, right? But the fact that you left it in exchange and you can't actually get any money out of it now is not quite something which the revenue has been very keen to be sympathetic to at the present moment. Of course, transfer is commonly a realization event. So in the vast majority of situations, right, the mere fact that there is a paper gain or loss on your token may not necessarily mean you have to realize the loss or pay tax on it, right? It is only when a realization event, is triggered, that the law says, okay, now we want you to take the gains or losses into account. It goes from a paper loss into, something that needs to be recognized within the tax system. And of course, in the case of transfer, because you are moving the ownership of the digital token to someone else, it is very common for transfer to be a realization event. Now, in this case, Manohar has already talked about GST or VAT, right? Goods and Services Tax or Value Added Tax. So given that there's an entire presentation on that, I shall not belabor the point over here. But essentially, what I'm saying is that, yes, it is true that in most cases, right, your digital tokens, if you exchange them, will be considered to be a barter. But then again, the fact that it is a barter raises certain issues, because if what you're transferring is a digital token and not fiat currency, then the supply of the digital token itself should actually attract a charge to VAT if the other standard requirements for charging it are present in tax system. And so what many governments have decided to do is they decided to say, if you are using a digital token as if it were money, right, to serve the functions as a medium of exchange, then that particular supply of the token will be exempt, because otherwise it doesn't really make sense to treat it as a barter transaction when you're only using the digital token as a means of exchange. Disposal. So digital tokens in general are designed to exist indefinitely, right? Most of the time, we're happy to leave them in the system. We don't really want to remove them unless there is a good reason for doing so. But they are tokens that are designed to be redeemed at some point, right? And the classic example will be that of utility tokens, although, as I will talk about a little bit later, liquidity pool tokens are also intended to be redeemed at some point, right? So the idea behind redemption is that where you give up the token, right, and in exchange you receive some sort of goods and services, your token is taken out of circulation. Now, this is different from the situation of a transfer, because in the case of a transfer, you may transfer the token to somebody else, but the token still remains somewhat in circulation. That person can take the token and transfer it to someone else. In the case of redemption, generally you take it out of the system. Well, token burning, this is quite interesting. Initially quite rare. I think we're starting to see a few more instances of this now. So what is token burning? Essentially, it's a share buyback. Right. The principles are very similar. Somebody goes into the market, buys a token, takes it out of circulation, and the purpose behind it, of course, is to raise the average value of the remaining tokens that are still within circulation. Now, the issue with token burning, of course, is because the language of token burning and what is currently in the statutes when it comes to the regulation of share buybacks may not totally overlap on this point. And so you might potentially have a situation where if you had done a share buyback under orthodox circumstances, it might be taxable or otherwise. Whereas in the case of token burning, we need to look very carefully at the legislation to see whether or not it is caught by the same set of provisions. So this is just an area which I like to give an example because it shows how the law may not necessarily have caught up. We start to see a situation where they are what I call functionally equivalent transactions. So they're transactions in as far as crypto assets are concerned that more or less do the same thing functionally as your orthodox traditional instruments. But whether or not the law has caught up to it and would apply in the same way is going to be a major concern for governments and tax authorities moving forward. Because if you have a different kind of treatment, what you're essentially giving rise to is the opportunity for tax arbitrage to take place. Okay, moving forward. So thank you for bearing with me on the fundamentals, right? Now let's go into 4 main emerging issues in crypto taxation, which I like to highlight. We can see a move towards active enforcement. So for the longest time, we have seen tax authorities quietly watching, not really saying very much about crypto taxation. They've now moved to issuing guidance, right? Now, many tax authorities have started to issue at least some form of guidance. Of course, we have the HMRC here in the UK. We have, guidance from Canada, from Australia, from New Zealand, a whole bunch of countries, Singapore as well. So the idea, of course, is that the tax authorities have realized that it is impossible to remain silent amidst calls for some sort of greater clarity on what the tax position is. And that's why they've come up with a whole bunch of guidance. The next stage, of course, is moving forward towards active enforcement. And I must admit, I do watch developments in Australia a little bit, but until listening to Elizabeth's presentation, I had no idea that they had moved along to quite such an advanced state. It looks as if the Australian tax authority is really quite far along this point. The fundamental policy question here, of course, is the potential tax collected worth the administrative costs? Because if you're a tax administration, if I may say so, particularly a developing country tax administration, you have bigger fish to fry, right? I mean, crypto is something that's very interesting at an academic level, but it depends on how much of your country's transactions are actually in the crypto sphere. Because if it is a very small percentage, then would you really want to dedicate staff to do it? Would you dedicate resources? Would you really want to go and train your staff to understand how to do crypto tax enforcement, right? If the payoff is going to be a very limited one. And what we're seeing in a lot of countries is essentially the tax authorities going, if the taxpayer comes up and declares the crypto gain to us, we will happily tax it. But we are not actually going to actively go after people, which has led to a bit of a misconception in many areas in the world that crypto transactions are not taxable. Well, I always like to tell clients who come to me that it's not that it is not taxable. Just because just because the government is not actively going after you doesn't mean that there is no tax liability. it might be a matter of time, right? And so I think that we are moving towards this so-called matter of time. The day of reckoning is coming, right? The balance appears to be swinging towards favor of enforcement right now, dramatically so in Australia, if I may say so. It looks as if the ATO is really, really moving in this direction. But one factor I like to raise, on why I think that the pendulum is swinging so much in favor of enforcement now is because governments have realized that there are going to be things that force them to look at crypto anyway. Right? As I will go on to discuss in the next point, it's no longer about gains, so to speak. It's about losses as well. And a government cannot avoid the fact if a taxpayer comes up to them and wishes to deduct the crypto losses. Now, you can't run from this and say you don't understand crypto at that point, because it is something which the taxpayer is actively trying to claim for now. And also there are risks of crypto-enabled crime and so on and so forth. So the position I'm taking over here, and indeed, I think the position that the UN is coming to as well, is that this is something which it's impossible to ignore, right? It is becoming necessary for tax authorities to understand how crypto taxation works and put in the resources, because even if they don't actively go after and chase the taxpayers, there's always a chance the taxpayers will come over and essentially shift the ball into their court by trying to claim a deduction or so. Which brings me to my next point, right? We've had quite the recent crypto meltdown fairly recently. Quite a few names over here might be familiar to us. Of course, the big one that's about to appear on the screen right now is FTX. Right? I hope none of us lost too much money in these meltdowns. But I think the point is that crypto is such that the losses that can be generated can be massive and can be generated very quickly. And we have a problem, of course, when people try to start to use these crypto losses to offset their other profitable sources of income. Because what you have is a situation where it's eating into the tax base, right? You can no longer collect income from other profitable sources of income if the crypto losses are used to offset such income. And this is a situation where a tax system would be particularly vulnerable to it if they don't really have experience in dealing with the ring fencing of losses and some sort of more advanced legal measures to prevent losses from being offset against sources that are not from the same source, right? And this, again, is more prevalent when it comes to developing countries, I would say, because when you look at developed countries, there tends to be a lot of high-level tax avoidance that's going on. So quite a lot of legislation would already be put in place to try and ring-fence losses and prevent people from using the losses against other unconnected sources of income. This may not quite be the case, if you have a tax system that is a little bit more basic, if I can put it that way. And of course, tax authorities are concerned about this. Our good friends, the ATO, will feature again over here, right? I believe Assistant Commissioner Tim Low mentioned that in most cases, forget about trying to use your crypto losses to deduct it against your income because you're not going to qualify, right? But I'm not so sure if all countries have as robust a system as Australia does. So it is going to be a concern for tax authorities around the world as to whether taxpayers will be trying to, use their crypto losses to offset against their income. And then just a quick point, tax lawyers are familiar with the use of artificial generation of losses, right? And that's why we have a whole bunch of anti-avoidance rules to try to prevent this. Well, artificial generation of losses for crypto, I think that's probably going to be popping up pretty soon as well. Indeed, we are starting to see signs of this. So moving forward, information gathering. I shall just go through this very quickly because I believe Elizabeth's presentation very comprehensively covered how governments can basically keep an eye on how, on what kind of crypto transactions and assets are being held and transferred around. Basically, the point I'm trying to make over here is it's not quite as private as one might expect. It is true that there is no direct mechanism within the DLT system itself for ascertaining who is the owner behind the wallet. But unless you are extremely tech savvy, it's likely that you are using a platform or exchange to try and transact your crypto. And almost all of your platforms and exchanges are going to be regulated. They have a responsibility to collect client data, to conduct know your client practices and everything. And so sooner or later, the tax authorities are going to get their hands on the information. It is simply not feasible to evade tax by assuming that information will never get out. And of course, crypto by itself, if you don't ever use it on goods and services or interact with the banking system, it's not going to be of very much use. So at the point in which it enters the system, you can be pretty sure that the tax authorities would have some idea as to what is going on. International initiatives, of course, exchange of information for tax and other purposes, has gone on for ages, right? We've got a lot of international initiatives on this, but the three that I'm highlighting over here basically are developments of this. Until fairly recently, they may not have been that much of a focus on crypto assets, but now I think we can start to see that your systems are catching up. Indeed, I think the European Commission's DAC 8 is now really in full flight at the moment. There's been a lot of progress in the area. It's probably the one that is leading the pack at the moment. We can expect a lot of international exchange of information to be taking place soon. I'm running out of time, so I shall just very briefly raise a few examples. Now, the key issue that we are facing when it comes to crypto taxation, I believe, is that the field moves so quickly. Right? And it is not just the developments in technology themselves. So of course, it is true that as the technology develops, you will have new kinds of tokens, new ways in which they're used and everything that a tax lawyer, for example, might have to look very carefully at and determine what the tax liability might be. But it is also the way in which the technology is used that changes over time, right? There is a trend in which there are trends of use, if I can put it that way. So to give an example, the first example, of course, if we're starting to see NFTs now being marketed together with physical goods, Nike would be a good example, right? Sporting goods, right? Would this actually affect the tax liability? Would this be something that tax authorities have to look out for, right? If, let's say, there are developments in the metaverse, if it becomes more widespread in the metaverse, does that mean that our underlying models of taxation will have to be relooked, right? So the way I'm seeing things is this is really just accelerating the debate for digital economy taxation. So the rules of digital economy taxation have not yet completely been settled yet. There's still an open debate on how to tax basically digital transactions and so on. And what crypto is doing is it's basically just adding to the debate and creating more questions there. I think I am running out of time, so I shall leave the rest as examples. But basically, the summary is as follows. Tax liability is derivative from economic activity. And because the forms of economic activity involving crypto assets keep developing so quickly, there is a need for us to constantly look at the nature of the transactions and how they evolve, and to see how orthodox tax rules can be applied to them. And eventually, as is going to happen, the legislatures will have to sit down and decide if they want to come up with a set of rules for crypto assets and transactions that are distinct and which can deal with the problem better. Because it does appear at the present moment that most of these rules, the orthodox tax rules, may not necessarily be fit for purpose in all situations when it comes to crypto taxation. Thank you very much for listening. I see there are 4 questions in chat, so let me start to have a look at that, please. Okay. Right. So yes, thank you, Elizabeth. Yes, resource allocation is a huge issue. Absolutely. And I think that it is something that is probably a bit more pressing on the parts of tax administrations that have more limited resources. So one thing that I hope that will happen internationally is if there could be some sort of support from countries which already have quite an established department dealing with crypto taxation, if they could share some of this expertise with other tax authorities, because certainly it's going to cost a huge amount of resources to train your staff, to get them to understand how the system works and everything. If there can be a bit of sharing of knowledge, whether it is through attachments to other tax authorities, whether it is through provision of manuals and stuff like that, it would be a good thing if tax authorities can share their knowledge with each other. Professor Niggar has mentioned related issue is the compliance costs. Oh yes, so of course when it comes to administrative efficiency, it's not just the revenue we're talking about, right? I think what we're seeing as a bit of an issue here is that we have a lot of taxpayers who wish to do the right thing, but the problem of course is they have no idea what the right thing is, because it is a field that is not exactly easy to get to grips with. And if a tax authority does not actually give some sort of guidance, right, or for that matter, even if there is guidance, it may not really be easy for a taxpayer to understand what is going on. And this really adds to the point, right, that we need clear guidance for taxpayers that they can easily understand what is going on so that they can comply. Ultimately, if there is a tax gap, it may not always be due to the fact of intentional non-compliance. It may just be a case that taxpayers want to comply, but they may not know what the relevant legal rules are. Right, I think I should be done here then. Are there any more questions, please?
Thank you, Vincent.